Joining us right now is Jason Thomas, head of global research and investment strategy at Carlyle. Good morning to you. I think there was an expectation, or at least over the weekend, that things might be a little bit more jittery than they are. What's your take?
Well, we have tariffs, trade wars. We have a tax, fiscal situation in the United States. Now, of course, geopolitics.
Right. This is like
it's a lot to absorb.
A laundry list of...
And I think what actually is hardest to understand is how these things interact. And so, it's not terribly surprising that there's not strong conviction to sell. And I think that's really all we're seeing today. It's wanting to get more information, and I think not only hope for that the Iranian nuclear program is neutralized, but also perhaps some expectations that if things deteriorate, there will be some easing up of tariffs and tariff risk.
Are you in the camp, though, that there won't be any kind of real retaliation? Because I think that for the market to be where it is today, you have to believe that this was some kind of one-and-done situation.
I really don't know. Again, I think that it's the interaction of all of these uncertainties. And I think that there's this hoped for, if things deteriorate and if the price of oil were to spike, that would be a time where you would not want to intensify the inflationary pressures with tariffs.
We're back to, markets at 22 times earnings again. It's up 25%. And
to me, the bigger concern is not where the market is. It's that bonds no longer hedge stock market risk. They did. They worked very well for a long period of time. But that was a time when the Fed, other central banks, didn't have to worry about inflation. So, if you go back to after the GFC, the Fed, anytime the economy hit a rough patch, anytime there was a sell-off in stocks, you could be sure that there'd be another round of QE with the express intent of driving down bond yields. So this, of course, gave rise to things like risk parity trades, where you could hedge your stock market risk with leverage positions in bonds.
So what's the new hedge?
And are you more worried about inflation than a growth slowdown?
Right now, what we see, I think that over the last few months, prior to the onset of tariffs, there was this sense that there was some sort of mechanism that automatically causes consumer prices to rise in proportion to tariffs. Of course, we found out that's not the case. You need management teams to actually increase prices. They've been reluctant to do that. Part of that, I think, is just they're worried about demand in their markets. The increasing prices, losing volumes, you're no better off. I think part of that is uncertainty. They think that why do I want to have difficult conversations with my customers if I think in 2 months' time these tariffs may not even be in place?
Did you watch Waller on Friday?
I think that...
Waller said even if, number one, what you said, the companies haven't done it for whatever reason. Number two, even if they do it, it's going to be a one-off. It's going to be either way.
That's the risk is the Fed. Let's be honest. It's a very dovish institution, right? It historically
has not been recently.
Well, but yes, of course, there was some cleanup to do after 2022, and they were heroic during that time. But
they're still fighting the inflation battle that might not.
But look at last year; they cut by 100 basis points without any material deterioration in economic activity of the labor market. So they generally want to get ahead of any, again, problems in the economy. In this case, they can't do it because if you preemptively cut when you expect a price level to increase because of tariffs, you're risking second-order effects. You're risking a relative price increase from tariffs actually broadening out. So I do think in this case, he thinks that those data will be evident by July. I think more likely September. But at some point, if they have to wait in this case to actually see genuine deterioration in the labor markets, and when they do, they'll act.
He said good cuts starting in July.
He did, and
good cuts, not slow down fear cuts,
reason,
but
right.
yeah, starting in July and continuing.
And what he also said was that he thinks a neutral rate is about 3%. I'm surprised that people still think that way.
Well,
I expect.
So you differ with him.
But I expect rates to oscillate around 4% for a long period of time. That means if you have a slowdown, rates will go down 3%, but that will be in response to a slowdown. I think what we've seen over the last few years is that the biggest change in the economy, in my view, is that we once had these massive cash-generative businesses, mega-cap tech, that used to be really asset-light businesses. They could generate $100 billion of cash from operations. Maybe they'd reinvest 10. Exactly. So now they're moved in a very different direction. There's now this competition for capital that imperils the Treasury market. I think that's why you have still upward pressure on bond yields, even though they look high relative to the last 15 years. And I think it's something that is also creates this inflation risk. What's so interesting about AI, we always talk about the future. We talk about what this means for the labor market, for productivity, for disinflation. In the short term, it's consuming much more resources. It's actually putting upward pressure on inflation because of this massive CapEx boom. An example of this, when you think about construction employment, you think this would be an awful time to be a construction worker. You have a peak to trough decline of 30% in housing starts, similar to decline in commercial real estate development, and yet construction employment has grown at twice the rate of overall payrolls. That's exactly. It's because of AI. It's because of data centers, and that has offset any slowdown related to those interest-sensitive sectors.
So back to, if you think the bond market is no longer the hedge for the equities market, what is?
It's private markets, and the reason I say that, it's because of the change in the demographics of public companies. So over the last 20 years, it's well known that there's been a 50% decline in public companies, but of course, the companies operating in the United States have increased substantially since that time. The U.S. economy, 3 times larger. What's missing from the U.S. stock market today is largely what you think of as middle market or growth stocks. And as a result, you have a equity market, stock market, that involves larger businesses. It's more concentrated and it's more correlated. So, of course, also dominated increasingly by passive flows like ETFs. And so it's the diversification on the equity side, but then also I think the pickup from the liquidity premium on credit.
Small businesses have not done well, Russell 2000, and that's because those small companies, I should say relative to the S&P 500 or to the big cap.
They're not attracting the inflows.
They also have tougher time dealing with some of the regulatory issues or the tariffs or things that come through on some of those. But big tech and big cap have been far more
again, I think it is very much related to the...
Does that continue or does that stop?
I think it's something that when it goes in reverse, you're going to see the losses among those companies as well. So what's been interesting over the last 5 years is that increases in passive flows have actually led to more concentration in the stock market. That is, the larger stocks have outperformed smaller businesses. So you had historically this size premium. Smaller businesses outperformed their large cap counterparts. That's reversed over the last decade. And that's something that, again, it's very much related to the changing structure of the market. And should those flows reverse, I think that's where you're going to see the drawdowns.
We got to go. There's a lot of good stuff, but I don't know what to do when it's all over.
Well, I can help you get into some private exposure so that you can diversify away.
I can avoid the ups and downs.
Well, it's funny when you think about the Russell 2000 as an example. In that drawdown in April,
right?
It was not. They did not sell off based on exposure to tariffs or regulations or other factors.
This is a longer debate. You need to come in another time because the bigger question about privates.
Yeah.
And yes, you don't have the ups and downs, but you really should be. In reality, you should be. It's sort of a fake situation.
No, you're saying, but this is the thing, that it's not fake. There's nothing fake about it. As an example, in April, the drawdown.
Right.
The most liquid quartile in the Russell 2000 sold off 4 percentage points more than the least liquid quartile. Why did that happen? Because in those shocks, investors sell what they can, what's easiest to sell. So these liquidity-driven increases in volatility, of course, they're of no consequence to private markets because those, the volatility of an asset is partly a function of the markets in which it trades. And in those markets where it's arm's-length transaction negotiated over time, of course, there's not going to be.
But if you can't get out of it, then
talk to Harvard.
But that's exactly. But that's the liquidity risk, right? So no one should minimize that. No one should minimize that. Right now in the markets, you have unwanted duration extension. Less money is coming back.
I hate that.
Right, you bought assets in one interest rate environment.
You have an
open
invitation to come back so we can actually talk about private versus public markets.